Welcome to Thoughts on the Market. I'm Matt Hornbach, Global Head of Macro Strategy for Morgan Stanley. Along with my colleagues bringing you a variety of perspectives, I'll be talking about global macro trends and how investors can interpret these trends for rates and currency markets. It's Thursday, April 30th at 10 a.m. in New York. Although this is my first episode guest hosting Thoughts on the Market, I'm going to use it to express a view that admittedly may open me up to a bit of scorn. And that's a forecast for a weaker US dollar. Before you react, believe me, I understand the skepticism, especially given recent investor appetite for the US dollar. Consensus on the dollar has been bearish for years, only to be proven wrong again and again. Critics say, okay, suppose you want to sell the dollar. What on earth are you going to buy outside of the US? For the record, I'm not suggesting investors buy the euro. Our forecast is based on the simple interplay of supply and demand. Prices of any financial asset, whether they be real estate, oil, or equities, reflect this simple relationship. Currencies are no different. In order to forecast prices, we have to analyze and predict the path of both supply and demand, regardless of their history. First, let's start with the future demand for US dollars. When we consider the outlook for global growth today, we see a broad rebound occurring over the next year. Although we're projecting a decline in global real GDP growth to negative 6.1% in the second quarter, our economists are projecting a snapback to about 10% this time next year. This projected growth inflection stands in stark contrast to the recovery after the great financial crisis, where global growth rebounded to just about 5.5%. While that rebound occurred from a shallower trough, and uncertainty naturally remains high around these forecasts, this snapback suggests that the demand for US dollars could subside from the current extreme levels. This rapid pickup in global growth is also likely to revive demand for commodities as well, including oil. Our global oil strategist, Martin Ratz, expects oil demand to improve gradually in the second half of 2020, while supply is likely to decline over the same period. This could mean a doubling in Brent oil prices into 2021 from current levels. The move in oil prices would increase the supply of petrodollars to oil exporting countries. So, we would expect a reversal of the marginal increase in demand for US dollars that resulted from the dramatic decline in oil prices that we saw in March and April this year. So, that's the demand side of the equation. But what about the future supply of US dollars? Despite our expectations for higher global growth, the improvement in labor markets and inflation dynamics should lag. This would keep most central banks on an easing path for an extended period. In particular, we expect the Fed's unconventional policies, which expand its balance sheet and increase the supply of US dollars, to simply outstrip other central banks. At the end of the day, our view that the US dollar will weaken this year comes back to the interplay between supply and demand. We see a dramatic increase in supply meeting and then exceeding demand. And while the demand for US dollars is at a fever pitch today, we don't think that demand is going to last forever either. Of course, we don't expect US dollar weakness to happen overnight, or against all currencies at the same time. The US dollar right now is going through a topping process after a multi-year bull market. These types of events take time and they require patience. And that's what we're recommending here. Investors should be positioning themselves for a weaker dollar over time. That's going to require a bit of patience. Thanks for listening. If you enjoy Thoughts on the Market, please take a moment to rate and review us on the Apple Podcast app. It helps more people to find the show.
The preceding content is informational only and based on information available when created. It is not an offer or a solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.